Hey, thanks for joining my video. Today's video is going to be going over rolling over or staying put, and it's a comprehensive video guide to deciding the future of your 401k savings. Now, retirement planning is a crucial aspect of financial planning. Deciding where to custodian retirement savings is a vital part of that process. Upon termination of the employment, regardless if your termination is by choice or not, a decision ultimately should be made. And the two most common options for retirement savings once you move on from an employer are moving the money to another employer-sponsored 401k plan or rolling to an individual IRA. When it comes to deciding between these two options, there are pros and cons to each. In this video, we'll explore the benefits of rolling over 401k to an IRA and leaving your 401k with a previous employer or rolling to the new employer's plan. By weighing the pros and cons of each option, you can make an informed decision about the best option for your retirement savings. Whether you're looking for greater flexibility, lower fees, or professional management, this video will help provide you with the information you need to make an informed decision about your retirement savings. Section number 1, rolling over a 401k to an IRA. Here are some of the benefits of rolling your 401k to IRA. Item number 1, wider investment options. IRAs typically offer a wider range of investment options than employer-sponsored 401k plans, such as access to individual stocks and bonds. Now, why is this important? Well, wider investment options are a key advantage of rolling over a 401k to an IRA. IRAs typically offer a broader range of investment options, including stocks and bonds, compared to employer-sponsored 401k plans, which usually only allow for broadly diversified mutual funds. Now, broad can either hurt or help. IRAs allow for greater customization of your portfolio so that you can build a portfolio that is tailored to your specific financial goals and risk tolerance. With wider investment options, you can make changes to your portfolio as needed to respond to market conditions or changes in your financial situation. You want to be proactive in managing your retirement savings and potentially find investment options that have a higher potential for returns. Diversification is another important benefit of wider investment options. By having access to a wider range of investment options, you can spread your investments across multiple asset classes that might not be available inside your 401k, which can help also reduce risk. This is essential for long-term retirement savings, as diversification can help ensure that your portfolio is not overly exposed to market volatility. When considering your retirement saving options, it's important to consider the range of investment options available and how they will align with your financial goals. Item number 2, lower fees. IRAs can also have lower fees than 401k plans, as you've heard the option to choosing among multiple providers, and they might have lower cost options, but not always. Item number 3, greater flexibility. Changes to the laws that went into effect January 1st of 2023, the Secure Act 2.0, it's actually narrowing the gap difference between group retirement plans and IRAs, but IRAs might offer a little bit more flexibility in terms of contributions, distributions, and required minimum distributions. Item number 4, avoid proprietary products. Rolling a 401k to an IRA can also help avoid being limited to a limited set of investment options selected by your employer, which may include proprietary products with higher fees. A deeper dive into this of why that's important and often overlooked. Proprietary products, they're also referred to as in-house products, are also investment options offered by the employer-sponsored 401k plan exclusively to those plan participants. These products may appear to be convenient, but they often come with disadvantages. For example, they usually have higher fees in compared to similar investment options readily available on the open market, which can have a significant impact on your returns and your long-term retirement savings. Additionally, proprietary products often lack transparency compared to the publicly traded investments. This makes it challenging to comprehend the underlying investments for the fees and performance. Furthermore, these products can create a conflict of interest for the employer, as they may receive a portion of those fees charged for these products, which could incentivize them to prioritize their own financial gain over the best interests of their employees. Lastly, limited access to a small selection of proprietary products can restrict portfolio diversification and appropriate risk management. Item number 5, professional management with an IRA. You have the option to work with a money manager who can help you select and manage investments based on your individual and financial goals based on your risk tolerance. Hire a registered investment advisory firm that has a fiduciary duty to look out for your best interests. Section number 2, leaving your 401k with a previous employer or rolling to a new employer's retirement plan can also provide positive benefits. Item number 1, no need to roll over. Keeping your retirement account with a previous employer means you don't have to go through the process of being time-consuming, possibly making mistakes, and having potential tax implications. Item number 2, many employer-sponsored retirement plans offer a diverse range of investment options and age-based solutions. So you don't have to actively manage your own portfolio. You can kind of set it and forget it. Sometimes simpler is better. Item number 3, consolidation to your new employer. Rolling retirement funds from a previous employer's plan may simplify your financial life by keeping all your retirement savings in one account. Item number 4 can be important, especially to pre-retirees in extreme cases. This can be beneficial in cases where you may need to have quick access to funds in an emergency or for a major purchase. The ability to take a loan from your retirement account without having to pay taxes and penalties could be a valuable resource for managing your finances. Additionally, the interest paid on a 401k loan could be tax deductible, further reducing the cost of borrowing money from yourself. Additionally, the process for taking a loan from your 401k is often simpler and more streamlined than obtaining a loan from a bank or other financial institution. This can be especially important in times of financial hardship, as loan application process can be quicker and less complicated than other options. Moreover, the funds from a 401k plan are often invested for long term and can have a significant growth potential, making it a valuable source of funding for short-term needs. Overall, loan availability can provide a valuable source of funding while helping you avoid disrupting your long-term retirement savings. With all that said, considering the benefits of rolling over a 401k to an IRA, such as wider investment options, lower fees, greater flexibility, and options for professional management, it can be a smart choice for those looking to take control of their own retirement savings. On the other hand, leaving your 401k with a previous or new employer can simplify your financial life and provide professional management, as well as the potential for employer contributions and loan availability. Ultimately, the best option for you will depend on your individual financial goals and circumstances. It's recommended that you seek advice from a financial advisor to help determine the best course of action for your retirement savings. If you found this video helpful, please click subscribe to receive future notifications on new videos. Thanks for watching. See you on the next one.